This is Agriculture Today. We are joined now by two very great guests that we are used to hearing from here on the show. And they're joining us from DC today. So thank you so much, gentlemen. We have with us Guy Allen. He is our senior economist with the International Grains Program here at K-State, as well as Dan O'Brien, our K-State grain economist. So gentlemen, thanks for joining me today.
Thank you, Samantha.
Absolutely. Like I said, you guys are currently in DC for that USDA Ag Outlook Conference, Dan, that we've been talking about the past several weeks during our grain market commentary. And the time has finally come. You guys are in DC.
Yes, it's a conference is started on Thursday, and it generally begins with the overall outlook by the USDA chief economist. In this case, it's Seth Meyer, and he gives on the ag side acreages, prices in general. Now all the specifics come in later on in the conference, but in terms of the acres, there's I guess not a lot of change. The USDA did come out and give a projection of 91 million acres planted, and their previous projection had been 92, so that's probably a little bit positive for the corn market. Really no change for the soybean market at 85.5 million acres planted. I think that's probably a little bit lower than what some people had projected. And you stand back and look at the markets right now, we have awfully high soybean prices and corn prices. So I guess they're arguing back and forth on that. And the wheat numbers came in at 11.1% increase. And there were comments this morning that some of those acres are probably planted for on the one hand, if you look at it positively for potential of garnering high prices, on the other side, because of high crop insurance prices. And so that's how we would view that out in the West. Probably the bigger story, in my view, and Guy, you can comment on this for sure, is that when they come up with their price projection. So for this marketing year, corn is averaging $6.70 a bushel. They came in with the corn projection for next year of a drop of about over $1 down to $5.60. And what's kind of buried in that assumption is that they're even off of those 91 million acres planted, they're looking at record high trend line yields, probably 180, 181, something like that. And with that, you're looking at probably a 15 billion bushel plus corn crop, no drought, no carryover problems in the Western Corn Belt that are enough to derail the train of a large crop. So that would be a drop of, like I say, $1.10 for corn. For sorghum, from $6.90 this year down to $5.60, and of course that affects us in Kansas, Oklahoma, Texas quite a bit. For soybeans, an average price this year of $14.30, but then next year a drop of $1.40 down to $12.90. So I'm sure our soybean folks will be looking at that and wondering about where all that comes from. I think a lot that's behind that, Guy, probably has to do with the large Brazilian crop. And that was also apparent this morning as they were talking about that they're not really counting on much more of a drop in Argentina. And that may be a heroic assumption, I think.
Yes. Well, Seth went on to explain that there's significant risks on both sides of that equation, both on the supply and the demand. And the weather, at the end of the day, the weather, he commented, is going to predominantly will drive the complex. But and that's what I really concur on. I think their production outlook and subsequently their price outlook is pretty optimistic on that. And I think from that base,
so their production outlook is optimistic. Their price outlook is pessimistic.
That's right. So look, significant risk on the production side with weather, not only in the U.S. dry in the Western Corn Belt, but in Argentina, still dry in Europe, still dry in critical parts of China. We're seeing drier weather in Australia, so they should come off their record production, and even dry in that critical part of West Africa around Nigeria and that. So I don't think we have much of a weather premium in the market. On the demand side, look, we continue to have a strong U.S. dollar. And if you look at the trade weighted currency index, it makes U.S. grain look very, very expensive. We have seen international freight rates come down significantly. So that helps us, one, with cheaper freight rates, but two, it keeps us more competitive from a comparative advantage situation where your markets that are closer, such as Black Sea, Australia, even Europe, it's not much of an advantage. I think we have seen some demand destruction there, and these high prices, I think, are sort of doing their jobs. But he also emphasized the tightness that we're seeing, particularly in corn and oil seeds. Wheat is tight as well for a number of years, particularly if you take out China. And I think we're still precariously on that knife's edge, and that's what keeps me a bit more optimistic on price.
Yeah, I would agree. What should also say too, they projected an $8.50 wheat price for the next marketing year. We're at $9 again this year. So they did talk quite a bit about the triple dip La Nina that has happened, and really the implicit assumption that will shouldn't say completely go away, but that will have better moisture and better crops this year.
Well, the weather forecasters have been saying for 6 months now we should see that La Nina situation fade and change to El Nino. We just haven't seen that happen yet, and the latest 90-day forecast doesn't see it happening really before May, and that's what makes me particularly concerned for the Western grain belt in the U.S. We're very, very dry out there as drought conditions persist. And we got a dichotomy at the moment between East and Western grain belt, but significant amount of grain coming out of there, particularly for the winter wheat situation. And as we go into planting here for both spring wheat and the summer crops.
And as kind of a look out farther into the future, there's discussion about anticipated 25% growth in crush capacity over the next few years still. Yeah. And they're looking at biodiesel, renewable diesel, biodiesel continuing to grow. And the long term of that, if you build those plants, will the acres come? I guess there'll be a demand for them, but how will the increase in capacity balance with the overall demand? I guess
I think there's 28 plants on the drawing board there. I don't think all those will get built. With the rising interest rates, a lot of these companies are re-reviewing their investment strategies, narrowing their windows for the return on investment and raising their benchmark for the return on investment. So I don't necessarily think all of those will be built, but it is going to dramatically change the crush dynamics in the U.S. going forward. I see that biodiesel, particularly in the whole biofuel situation, continuing to have traction going forward, which is going to drive that oilseed sector. They seem to be quite concerned about the meal, but look, meal prices are really hanging very, very strong relative today, and we haven't seen that fade yet. Maybe some concern in the future. I'm not as concerned about that as maybe some are. The markets will work it out, I believe, really find that demand. But I think, longer term, need to keep a close eye on that. Which of these plants are built, when they come online at a commission, that's going to change domestic trade flows there. But I see that as all good for production agriculture.
Samantha, I know there's a topic that you and I've talked about in the past. You're always interested in what farm income will be and how farmers will fare. They did project that farm income for next year, coming off of a high, near record high, 2022, that it'll be down tangibly in 2023, and that would mainly be with the lower prices. I think they're balancing bushels and prices together and kind of a horse race to see where that ends up. They talked in cautious tones with regard to what happened with cash rents, and so they're saying that, not saying that cash rents won't increase, but that increases will moderate. I was a little unsure exactly what was being said there, but anyway, and so again, probably the bigger thing, and I know it's like I say, it's a concern to you. It would be where farm income goes, and they're anticipating a little bit worse year next year than this year.
Yeah, it definitely indicated farm income would still be strong, but less than last year. Look, I don't think these inflationary pressures are going to go away anytime soon. I think some of the message in there was couched in a bit of more macro politics, but that's the other thing that keeps me rather bullish commodity prices is I really don't see this inflationary, particularly food and energy inflation, really fading much. They came down last month to report a bit, but the world situation really hasn't changed a whole lot. And I continue to think interest rates are going to continue to go up. Inflation still going to remain fairly high in those sectors. And that's going to fuel commodity prices a bit higher in the nominal sense. In the real sense, maybe not. But it's just increasingly, I think, particularly for growers to manage that risk and their margin as they buy inputs going into spring and market some of their crop on the output side.
Samantha, any questions for us that you'd like to ask?
Well, you ran my mind exactly, Dan. It's like you knew exactly where I was going. That was going to be my next question, was farm income questions in terms of, these anticipated price decreases that we're seeing, because it feels like everything else just keeps going up in price. So when it comes to anticipating decreases, where do our producers, see themselves if that's going to be the case? So you answered that question for me exactly. So that worked out well. And I know that you guys still have a lot more to learn while you're at this conference and a lot more to hear from some of these USDA personnel. So I know we'll probably have a follow-up conversation next week along the same lines with all that you have learned. But thank you so much for carving out time while you're there to speak with us today. I really do appreciate it.
Quite happy to. Thanks.
Thanks, Samantha.
Absolutely. You guys enjoy the rest of that conference and enjoy DC. Hopefully some nice weather.
Yep.
Yeah.
But so far it's pretty nice. I don't think we're quite as cold as is reported back home. But I'm sure by the time we get back home, we'll pay the price.
How cold is it this morning in Manhattan?
It was fairly chilly this morning. I woke up to 7 degrees. So
Okay. That would be a bit chilly.
We're going to get softened up coming out here.
I think it's supposed to be 80 degrees on the weekend. So maybe it'll bring the cherry blossom.
Right.
There you go. That'd be wonderful. Well, hopefully you guys get to enjoy that. But once again, thank you both so much for all the insight you provided today.
Thanks. Take care.
You as well. Once again, everyone, that was K-State grain economist Dan O'Brien, as well as Guy Allen, the senior economist with the International Grains Program here at K-State, joining us for this week's grain market update. We'll be back with more ahead on Agriculture Today.